You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That music means it is time once again for the return of the weekly program that you guys are just devouring these days. Yes, it's time for Options Bootcamp once again. Glad to see you guys are enjoying the weekly edition. We wanted to make sure you guys didn't just get it twice a month. No. Every week in your ear holes on your podcast device. Glad to see you guys are responding. If you like what you hear, and a lot of you clearly do, head on out to your platform of choice, wherever you're getting this. Make sure you leave a review so new people can continue to discover Options Bootcamp at a time like this, a program like this, perhaps even more necessary than usual. So keep those reviews so we can keep the flood of new folks discovering the program these days. My name, of course, Mark Longo from theoptionsinsider.com, as well as from this fine network upon which you're listening to this right now. If you just subscribe to Options Bootcamp, I know a lot of you like this show. Hey, I won't fault you. It's a fun one. Make sure if you haven't done so already, you upgrade to the full network so you get everything. Everything we do is over a dozen programs there. We will keep you informed. We will keep you educated. We will keep you up to date and maybe a little bit entertained as well over there with options. You will not be wanting for options content. I guarantee you that. There's 13 plus years worth of content for you guys to download and consume at your leisure during your free time. We all got a little bit more of that these days than perhaps we anticipated. So check them out. I think you will find them interesting and or enjoyable. And joining me on the old program today, you may find him interesting and or enjoyable. That's up to you. Let's find out. He's my compadre here on the Options Bootcamp Drill Instructor Proving Ground, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Also the author of a few options tomes out there like Trading Options Greeks and all sorts of other fun stuff. Mr. P, welcome back to Options Bootcamp, sir.
Hello, Mark. It is very good to be back.
And joining us, holding down the NASDAQ hot seat today, is a newcomer to this program, even though you probably know him from his many appearances on the Advisor's Option, a few guest starring spots there on Vol Views, and a few other shows. Yes, he's Mr. Option Rats himself, a.k.a. Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome for the first time to Options Bootcamp, sir.
It's great to be here with Dan. I was just thinking, the Advisor's Option, Volatility Views, Crypto, the Tech Show.
Oh, that's right. I left a couple off there.
Yeah, and so, I'm going around the horn here at the Options Insider.
Slowly just insinuating yourself into all the programs out. You're like a virus. You creep and you spread And next thing you know, there's no getting rid of Mr. Option Rats. At least not for the next hour. As we head on into our next segment, it is time to go into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
Oh, yeah, so festive. We can all use a dose of that festive music right about now. Welcome to Basic Training, the portion of the show where we break down a basic option strategy or tip or technique and explain how you can utilize it in your own portfolios. And Dan, today's subject, you're to blame for this subject, I think. 'Cause I do believe a few episodes back you suggested it was an interesting time to perhaps put on some calendars, some time spreads, and that just unleashed the whirlwind. We got so many questions about time spreads and their use cases and things like that. It seemed like now was an opportune time to revisit this topic. This is the topic we've touched on in the past, and I encourage you listeners, if you're new to the program or indeed to the network, go back to the early days. It's kind of fun just for a bit of a trip down memory lane, too, to listen to some of the firms that were on the show in the early days that don't exist anymore. A bit of a list history lesson through the world of options, brokerage, and education. Then, of course, we touched on time spreads a few different ways in the past, but they're going to do a little bit of a deeper dive, a bit of a revisit of them today because they are so timely. Pun intended. So we're going to get to all that in a few seconds. But first, it is kind of a rare, kind of a weird, kind of a strange chin-scratching time in the markets. So I want to kind of get everyone's thoughts really quickly. Let's start with our guest, Mr. Matt, because you are the keeper of the data and the analysis and the volatility trends and the earnings volatility, all that good stuff. A lot's unfolding in the marketplace. We're just coming as we're recording this on the heels of a long weekend where we saw a lot of concern heading into the weekend. Markets kind of mixed it down. And then, of course, we're in the middle of rally-ho mode yet again. In fact, the NASDAQ threatening a new all-time high yet again as we're recording this, which is perhaps a little bit interesting. I'm curious for you, Mr. Matt, before we begin here, what are your thoughts on where we find ourselves from an overall market and indeed from a volatility perspective, sir?
Well, this is easily the strangest market that I've been involved in. And I started my career before many people were born in 82, 83 at Lehman Brothers as a runner. So this is quite crazy. I was in Reuters being interviewed in January, late January, and I'm on record as saying this is going to be a bad virus where we should be down at least 10 to 20%. And lo and behold, it rallied after that. I'm doubting myself. I'm going, what's going on? Like I've got out of all my stock, but it worked out. And then near the bottom, we were, it showed all the signs, went on LinkedIn and showed these graphs of the volatility getting into 2008 levels. The market width is another thing that we look at when I'm an old market maker, and when the spreads get very wide, that looks like a good bottom. That's when you see capitulation in the market. So we had a pretty good call of it then, and then we rallied up a little bit, and then I'm ready for the second shoe to fall, and lo and behold, the market just keeps creeping up. Well, a lot to be said about trillions of dollars coming from the Fed, but still, it's kind of a shock that we're just drifting up, and everyone's kind of looking at each other. All my clients that are calling me, family offices, pensions, there's a lot more interest, and now this market has gotten people's interest in options and protection, I haven't met one bullish person yet. The market continues to go up, so. This is a crazy market, Mark, but there's a lot of interest and there's a lot to do out there.
I think that's a good analogy. I haven't met one bullish person, yet the market continues to go up. I found myself in a very similar camp, all the people that I interact with and talk with on a regular basis out here. And certainly just, we're recording this right now from the heart of downtown Chicago. So maybe that skews our perspective a little bit. But I just took the opportunity yesterday, Memorial Day, everything was shut down, to kind of just tour the city a little bit again, see what's going on out there. And spoiler alert, not a heck of a lot. If you're not familiar with Chicago, this is really kickoff time for aggressive summer tourist season, and there is nothing open. There's nothing going. The tour boats aren't there. The crowds of tourists aren't there. Every building is empty. Every restaurant is shut down, obviously. And it's a much starker contrast to saying, even if a vaccine is developed tomorrow, are all these things going to immediately reopen and get back to their normal levels? Probably not. So you're right. The breathless enthusiasm for this market that's out there, that's driving up everything. We've had a lot of discussions on other shows about, whether it's just really the top 5 tech names that are lifting everything up and everything else is kind of middling right now. It does seem like there is a lot of optimism that I guess everyone's going to go to work for Facebook and Amazon and all is right with the world. But it is a strange time. Mr. Dan, before we get into the time spreads really quickly, what are your thoughts here on just what we're seeing out there right now? These, as Matt put them, the strangest markets he's ever been a part of.
Yeah, I don't think that I have met a single bullish person either. I think the three of us must be running around in the wrong circles because somebody's buying this stuff, man. I don't know why, but
are your crazies coming to you in the market taker chat and the mentoring? Are they bullish? Are they looking for hedging? What are they coming to you for right now?
We've largely steered away from just trying to guess the direction and been doing a lot with some neutral strategies and some sort of market indifferent strategies, particularly earnings, which is great. That was a saving grace for a lot of our traders because, you just can't guess if it's going up or down right now. But to take advantage of something where it doesn't matter if it goes up or down, oh man, let me tell you, that has been our saving grace.
Well, let's get to another saving grace, which is, of course, the basic training. Like I mentioned, Dan, you are responsible for invoking this. You mentioned time spreads. Apparently, that's a trigger for a lot of the audience because they went crazy. We love your questions. Keep them coming. They had a lot of questions about this. So again, it seems like a good time to perhaps revisit the time spread in a little bit more depth. You may also know them as a calendar spread, listeners. They're very, very straightforward calendar time that's going to show you're kind of playing a little bit on the expiration curve. You're not all just hanging out in the front month or whatever, the same month like most of your strategies probably are. We're going to play a little bit with time, hence the name out there. And the most traditional flavor, the one you see most frequently cited out there, is going to be a typical, usually involving the calls. And it's going to be pretty much a 1 month time spread. So you go maybe 2 months out, you buy an at-the-money call, and then you turn around and you sell a 1 month call in the front month out there. That's usually a typical flavor out there. Looking at our old friend NDX, which is threatening new all-time highs, closing in on 9,500 coming into showtime out there, which who would have thought we'd be saying that a month ago? Judging by all our audience polls out there, not you guys either. So a lot of you out there have been kind of fading this as well. But c'est la vie, conversation for another day. So looking right now, just pricing up your traditional July, June, kind of 9,500, kind of an at-the-money call time spread out there. It's pricing up right around about $122 right now. So what are you paying out there? Of course, you're paying for the little bit of extra time premium for the extra month. You're paying for the extra vol premium that goes into that. And as a result, that's the net outlay for a 9,500 time spread out there in NDX right now. Mr. Matt, you're the keeper of all the data, the back tests and all the other fun stuff over there. What are your thoughts on time spread in general? If you have anything you want to add to that description out there for the listeners. And also, if you always come armed with some interesting data. I'm curious if you have any interesting back tests or analysis you want to share with our audience about time spreads, sir.
Yes, I do. So I'll just start when I started trading on the floor. Everyone has their own style, and some of the people that I traded with were only looking at time spreads, and they really looked at it, and they knew their stocks, and they knew where the time spreads usually traded. And I thought it was such an odd way to think of things, but I've since come and seen the brilliance, the geniusness of looking at time spreads and understanding. I need to prove things to myself, so I calculate what's called a forward volatility, and what that means is so you'll have, when you're doing a time spread, you mentioned like a typical 30-day, 60-day. So you look at the volatility implied to 30 days, and then you look at the implied volatility at the 60 days. And then there is, so let's say what is usually the case is the front month, the 30-day is less than the 60-day. So what that means is that the volatility 2 to 30-day will be lower than the volatility between the 30-day and the 60-day. So that's called a forward volatility, and you can measure that. And then that's how I tend to think of these time spreads. So there's a lot of ways to measure that. Mark, you just valued the time spread. So what you could also do is, with a theoretical value calculator, you can go in and do what's called a flat volatility to price that. And this is a little bit more advanced, but this is an interesting way to look at it. So you mentioned the price, whatever, $100 for that. Now, what you do is you try to find the volatility that you set each of the 60-day and the 30-day that makes that theoretical value equal to what's in the market, and that's called your forward flat volatility. So there are two. I gave you two different measurements of it, and then actually when that ratio of those measurements get out of whack, that actually is an indicator for us. So now I'm getting very advanced, but I just wanted to add something to your very good description of what's going on in a calendar. And then the way I like to think of a calendar is think about what's the best. So if you own a calendar, you want the price at the expiration of the front to be right at that strike price. So in the case of NDX, right at the 9,500, and that is where your front option expires at 0, and your back option is the most valuable in relation to your front. So that's where you want things to go. So if you think of a payoff picture, it looks like a peak, like a mountain, like Mount Vesuvius. How's that? And you want it to stop right there on the peak. And what you also want is volatility to go up while it lands there. So some of my favorite ways to play a time spread is to do it where if it goes to that point, the volatility will go high. So I like to do a put calendar where it would go down, volatility would go up and land there. Those are the types of puts that I like to do. Now, you're right. I went and back tested a ton of these using NDX as the underlying, using various days to expiration. You could do a short term, like I did a 30-day versus a 10-day. You could do longer term, 120-day versus 90-day. And what you'll find if you do it in NDX is not a good candidate for a time spread, because NDX is just moving one way and going through all of these, where you want it to land usually. So it's not really landing where you want it. If you look at the graph of NDX, it's just kind of one way up, one way down, one way up, one way down. That's not good for time spreads. So, but there are some that do work, and it is some of those ones that are a little bit more out of the money. So you can imagine a 30-day, and you'll guess, if the NDX continues to go up, where it's going to land. So if it lands up there, then that's exactly where you want it. And so those are the types of, most calendars that I've tested in NDX, don't return any significant amount, and most of them are losers. However, the ones that do show profit over back to 2007 are the ones that are slightly more out of the money, and that gives the stock a chance to go to that point. And when the expiration occurs, that's usually the best place to for the stock to be for the holder of the long calendar. It's called long when you're owning the long dated month and you're short the front month. Now, opposite, you can make money being shorted, but that's a lot more challenging from a margin perspective. For retail margin, that's an expensive proposition because that's treated as a naked option, the longer term one. If you have portfolio margin, it's a different story. There are some decent short calendars that you could do, but that's the story, Mark, on the back test. My feeling on it and where you want it to be when it ends up.
Good breakdown, sir. That's why I like having you on a program like this. You come armed with the data. By the way, people always ask us, what you just mentioned there. Why don't you talk about the short calendars? Not many, a few. The hardcore is ask about that. You're right. You can do these spread/calendars both ways, but the most common use case is indeed the long calendar, where you're buying a farther out contract, selling the nearer duration contract for the reasons that Matt just outlined. Otherwise, if you think about it, if you're selling that farther out contract, you're effectively naked on that. So the margin requirements alone are onerous for most retail out there, which is why we don't look at it from that perspective. But maybe down the road, we have touched on it on some other programs in the past. It might be worth maybe revisiting that again down the road as well. But it's 99.9%, I'm fairly certain, in that number off the top of my head, of calendar spread use cases, the way we're going to break down right here. Mr. Dan, you're the reason we're talking about this right now. Walk us through why you like calendars, why you liked them a month or so back when we were doing the show, what made that scenario very optimal for you, and what are, in general, some of your thoughts on time spread/calendars for our audience, sir?
Yeah, they're pretty flexible, which Matt sort of alluded to, citing a couple uses for them. When we started talking about this a month ago or whatever it was because we were in the thick of earnings season, and calendars can potentially, like when the right set of criteria is met, can be amazing earnings trades, because you get to take advantage of that what I'll refer to as term structure volatility. And then they're good now too. I traded a time spread within the last few days on Apple that worked out great. It was, overnight trade, actually. Didn't necessarily intend it to be, but everything just lined up perfectly and was able to take a pretty nice profit within about 24 hours. But the thing, just the guiding principle that I really love about time spreads, whether they're directional or non-directional or earnings, is that we talk to all of our students about getting edge and not being a guesser, not being a gambler, not trying to get lucky, not hoping and praying, but no kidding, having a statistically sound strategy. And I will tell you what, it's my opinion that calendar spreads, time spreads, are the strongest candidates for those types of strategies, for strategies that have a measurable, actual mathematically measurable edge that you can get. And if you can do that, that's what trading's all about, at least good trading, on the highest level.
It's an interesting strategy when you're talking about time spreads, because you're talking about traditionally buying the spread. So you're going out, buying the farther off one. That's, of course, going to be the more expensive one, as in the example I just laid out for the NDX, but pick any underlying you want. Dan's just talking about Apple. Pick any one. The farther off leg is going to cost more for all the reasons we've broken down with the Greeks here on the show in the past. There's more time premium, there's more volatility premium, all baked in to that contract as well. So you're buying a more expensive contract. You're selling a nearer term contract. Typically, when you think about buying something, you want that underlying to move. You want it to get up and going. And yet with this time spread, it's kind of counterintuitive. You're going to buy, usually, again, in the at the money. Matt mentioned the out of the money example in NDX might be more preferable there. But traditionally, the use case is at the money. You're going to buy an at the money call, let's say, 2 months out. And you can sell an at the money call 1 month out. So what does that typically mean for you? You're short that nearer dated option. Do you want that contract to sit there? And that's why Matt alluded to that Mount Vesuvius there, where the kind of maximum profit is right in the middle there of that chart, where you don't really get a heck of a lot of movement. So there's a lot of counterintuitive elements to a time spread, buying premium, yet you want it to sit, all these other things that are kind of a little bit difficult for people to wrap their heads around. Matt, if you have any thoughts on that, I'd be curious to hear them. And also, people are always asking for ways we could tweak and upgrade these. And when you're talking equity and index options these days, 90% of the game is in the weeklies. So people want to upgrade their time spreads by, instead of going maybe the old route of 2 months out, 1 month out, going maybe 1 month out versus a weekly. So a little bit different, obviously a little bit more involved from a trading more frequently perspective, so a little bit more commissions and things like that, but potentially better performance. I'm curious on both of your thoughts on those. First off, the somewhat counterintuitive nature of time spreads in general, and then B, your thoughts on maybe tweaking them with a little bit of the weeklies instead of using the monthlies.
I was nodding while you were saying that. I like I said, in my early days had a difficult time with time spreads, and I think that the advice that I would have for someone learning is, if you're comfortable with it, some people really get it. And I agree with Dan. There's some very good opportunities with earnings, because what's happening is the implied volatility is jumping around, and often you could get a good relationship. and that you get that edge on your side. So, for earnings plays, especially, we've talked about this before, Mark. Time spreads around earnings is a very good way to approach it. But again, the trader, the beginning trader needs to understand where they're strong and where they're weak. And so if you don't really get the time spreads, try to learn them, because they're a very important tool that you can have. But if you don't get it, either trade it very small or just paper trade it or ignore it altogether. So that's would be my advice. Now, on the weeklies, I think this is interesting because what our software, our backtesting software does is we can plug in a bunch of different day relationships and delta relationships and run them all together. So it'll be hundreds of tests come out. And I was curious, the worst test from owning a calendar was as you mentioned, the very short term. So I'll tell you the worst test. It was a days to expiration was 30 days and on the long and 10 days on the short. And the delta was a 60 delta. So spread or a put time spread. So an in the money put, you are long. So you're paying a fair amount for that. And then there's also the delta of the short of the 10-day was 45. So that particular test was the worst performing. And when I flipped it over and ran it as a short put time spread, it did perform well. So I thought that was kind of interesting. And that's, generally trading the weeklies, generally, seeing where, you're right, the volume is so high. And calendars, people don't think of them often for weeklies. But, in this case, that is an interesting way to go. So basically what you're doing in this case is the test was buying a lot of premium. However, the one that worked, the short side was actually selling premium. So what you could think of it as is a way to sell premiums. It's really selling a put and covering it with a shorter dated option. So it's just as we've seen, selling naked. It looks like a good. It looks like a good strategy until you get hurt. But this is using a time spread in order to basically put on what is mostly just a short put in this case, Mark.
A lot to unpack there. A lot to unpack on this episode. Unfortunately, we're kind of coming up against it, so I'll have to get to your questions on time spreads in the next episode, listeners. But we're not going to wrap up before we get to another flavor of time spreads, which is indeed the diagonal. We talked about the traditional time spread, which is buying one at the money call, 2 months out, selling one 1 month out. That's the most traditional flavor. You can play with it in weeklies and other things like that. But some folks like to play with those strikes a little bit. They don't want to just be stuck with the at the money. So let's play around with our strikes a little bit too, and let's go diagonal up this options chain, hence the name of the strategy, the diagonal. Draw a line between those two strikes. Got a bit of a diagonal line over there. And let's play with that here, like we talked before about the 9,500. That was the at the money time spread out there in NDX right now, June, July. That cost you about $122. Let's play with it a little bit. Let's go June 9,500, and let's go up 100 handles in the July portion. As Matt said, give you a little bit of room to run on that one. And now all of a sudden, you're costing about $66, roughly half the amount pretty much out there. So you can see immediately what some of the appeal of this strategy is that, of course, it's going to cost you a little bit less outlay to get the thing going out there. Dan, this is always an interesting discussion, when to use a diagonal, when to use a traditional calendar. What are your thoughts on these two different types of spreads, and when do you like to utilize one versus the other, sir?
Yeah, like the strength, like I was saying about calendars in general, is that you can get an edge on it. You can get a statistical advantage. So, I mean, for me, the difference is I look at doing a diagonal, and probably the most common diagonal is when I buy, when you buy a longer term in the money call and sell a shorter term out of the money call. You can set it up a whole bunch of different ways too, but that's the one that is commonly used, more commonly used. And to me, that's like I like to refer to it as a poor man's covered call, though there are some very important key differences. And basically, it kind of is a covered call with a built-in synthetic put, with a built-in safety feature, because if the stock ends up being the next Enron, you don't get creamed. But you're able to really use the volatility disparity when it exists, to be able to put it on again, just taking advantage of that edge, of that statistical soundness. And even if it's a different type of diagonal, just having that extra tool, that extra thing that's working in your favor can be really, really powerful and make a gigantic difference in the long run if you do that a lot.
All right, listeners, unfortunately, that music means we've come up against it. You guys have a lot of questions, I know. Stay tuned. If you're listening live, you get to hear the answers pretty much right now. If you're listening after the fact on the podcast, you got to wait a week, unfortunately. Them's the break. That's why you should join us live whenever we do these Options Bootcamp recordings. So we'll get to all your questions about time spreads and diagonal. You guys have a ton of them, as well as try to squeeze in a few more on the next Super Mail Call edition. Really quick review. We just talked about time spreads, your traditional use case. Of course, one at-the-money call that you're buying traditionally 2 months out, or it could be many more months than that, but traditionally a couple months out, and then selling usually a front-month call. Maybe you play with the weeklies. You can play with it a little bit. You can also play with the strikes a little bit and get into diagonals rather than traditional at-the-money time spreads. It's a counterintuitive strategy because you're buying premium, but you want the trade to sit there, which is why a lot of people have issues with it and questions about it. Also, we've had people write in just on recent episodes about what do you do with the two legs. Maybe we can get into that again a little bit on the next episode. Do you take them off one at a time? Do you let the first one expire and get a cheap flyer on the second one? All sorts of weird use cases for time spreads abound, which is why I often refer to this as kind of more of an options 201 or maybe even a 301 strategy rather than just an options 101. But hey, we're here doing our basic training, so it's all got to squeeze in under that rubric. That's kind of all we have time for right now. Again, we'll get to your questions next episode. But before we go, let's go back around the horn and check in with everybody, see what they have cooking that may interest you. Let's start with our guest, Mr. Matt. Matt, if folks want to contact you, maybe they want to back test some time spreads for themselves, maybe they want to talk about earnings volatility or dividends or any of the other things you guys do over there at ORATS, where should they go? What should they do, sir?
That was too short, Mark. I'm ready to go. I'm just getting warmed up here.
Don't worry, there's more to come, sir.
ORATS.com. And my email is matt@ORATS if you have any questions. We have, like you said, the backtesting tool is actually quite a good educational tool as well. We also have new scanners, so you can put time spreads in there, and we have ways to assess each one of the trades that appear by our volatility forecasts or by how they look in the market. So there's a lot of things that you could do, and then track it with paper trading. So that's how I'd like to learn about these time spreads. Put one on a paper trade, watch how it moves. Watch how it goes to Mount Vesuvius in the middle, and then falls off if it goes through that strike. But yeah, come to ORATS.com and check out the tools there. That'll help you learn about time spreads and learn about many of the other option strategies that we track, and of course implied volatilities, dividends, and all that, Mark.
I like that. The Mount Vesuvius of time spreads. Check it all out for yourselves. Maybe kick the tires for yourselves using a back test or a few other things. ORATS.com. ORATS.com is the place to go. And, of course, give them a follow on the old Twitters as well at Option Rats. One of those memorable handles. Can't forget that one. You like options? Maybe you like rats. Put them together. Option Rats is the place for you on the old Twitters. And, Mr. Dan, if folks are intrigued, perhaps curious, perhaps they have questions, and judging by their email, they clearly do, about time spreads or anything else, where should they go? What should they do, sir?
You can visit us at markettaker.com, 2 T's in a row, market, like stock market, taker, like take something. Visit us and, just click on that little link that says contact us. We're in the midst of redoing our website. Very, very exciting. It's kind of a fun little project. So who knows? Maybe by the time you hear this, we'll have a bright, new, shiny website for you.
Bright, new, shiny. Check it out for yourself. MarketTaker.com, 2 T's. Market and then Taker.com is the place to go. And on behalf of the Black-Hatted One and Mr. Option Rats, and indeed myself and our friends over there at NASDAQ, thank all of you out there for downloading, streaming, subscribing, for sending in your questions. Don't worry, we'll get to more of them on next episode. And we'll see you then for more episodes of Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ. Tech forward. Leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.